Good morning, hello and welcome. It is 11 a.m. and you're with us on Trading Hour. I'm Surabhi Upadhyay. With me as always is Reema Tendulkar, and what we've got is a very, very range-bound market where the range on the Nifty is barely 150 points, and right now we're closer to the the upper end of that range. One could perhaps say right in the middle thereabouts. But trends are very hard to come by. I mean, that's been sort of a facet of today's trading action so far. There are a couple of metal and material stocks that are doing reasonably better off. Power seems to be a theme that's trying to build today. If you look at some of the gainers, for instance, on the Nifty, that'll illustrate the point. So you've got a Coal India, you've got an NTPC, you've got a Power Grid, there's a Tata Steel. So these are some of the stocks that are doing well. That's the contribution chart that's coming up there for you. But you can see even on the dragging side today, the banks are not performing, the larger banks, and therefore you've got those cuts coming in on the likes of HDFC as well as ICICI Bank. And a couple of others like TCS, heavyweights like TCS are lower. Some of the two-wheeler stocks, they are cooling off today, Eicher Motors and Bajaj Auto. So it's really basically, it's a muddle, it's very range-bound, it's all over the place. Cipla deserves a mention. Cipla has had a very interesting week so far. First, very negative reaction to earnings, some recovery yesterday, and good follow-through buying today as well. So Cipla is one of the smartest stocks on the Nifty actually so far this week. That's the trend. Otherwise, mid-cap index showing a better gain than the Nifty. Reema, hi. I guess it's a little all over the place, at least for the large caps today.
Well, but the action is in the broader markets, right? The mid-cap index, the small-cap index, all showing you gains of close to about 3/4 of a percentage point. Very strong advance decline ratio too. That's up close to about 5 stocks advancing for 2 in the red. But let's straight away get to a corporate conversation. Orion Pro Solutions reported their Q4 numbers. The company's posted a 30% jump in revenue and a 30% jump in EBITDA too. EBITDA margins have come in at 21.3%. The company says they expect the growth momentum to continue into FY25, and they're guiding for a 30 to 35% revenue growth next year. Ashish Rai, the CEO of Orion Pro Solutions, is here with us to take a few questions. Mr. Rai, morning. This is Reema here. First, FY24, you've ended with a growth of 35% at the upper end of your own guided band of 30 to 35%. What makes you confident you will be able to achieve a similar 30 to 35% growth in FY25? Give me 3 reasons, because the guidance that we've heard from some of the larger IT services company seem to suggest that they're still very cautious about the macro environment. So 3 reasons why you will be able to achieve a 30 to 35% top line growth in FY25.
Yeah, good morning, Reema. Thank you for having me. Look, I think so. We don't do IT services, so I won't comment on that, right? I mean, we do pure tech. We do deep tech, we build products based on hard R&D, and we are out to build out a global IP-led products and platforms player that can play in the segments we choose on a global basis. So really, I mean, I can't comment to the IT services demand, but we see an unprecedented demand environment for our offerings, both on the banking side as well as on the technology innovation group, right? So this one, I think demand environment is just exceptionally strong across most of our markets. The pipeline and the order book is at record levels right now, so we feel very good. We've now been growing 30% plus for 3 consecutive years, right? So since we pivoted away from services into building out a products and platforms player almost 4 years back, last 3 years we've grown at 30% plus. We feel good about continuing the growth trajectory. In fact, we listed back in 2005. For the last 19 years, we've grown at 30%, right? So it's not really. If you look at the CAGR, I think we feel very good about where we are. We feel very good about demand, pipeline, execution. So yeah, I think we feel we'll deliver.
Okay. So one significant thing next year is going to be the cash deployment, because you recently raised money via the QIP and the preferential issue, and you've got some marquee investors on board too. So what's the cash balance, and what are you planning to do with the cash book, the cash balance that you have?
Yeah, so look, I think we published the balance sheet at the end of the, so for 31st March, but of course the QIP happened after that, and we raised a further 270 crores, right? So I think we ended 31st March with a balance in the range of, I think, 250, 270 crores, and then the QIP 270 sort of adds to it. We are obviously, we've done almost 3 acquisitions in the last 6 months, so we've been deploying cash in M&A, which is quite clear. We recently, after the year close, we deployed cash in the Arya.ai acquisition that we talked about. And I think going further, some of the capital will go into organic growth because we've been growing at a tearing pace. So there is a lot of organic growth capital to be put into the business, but a fair amount will also continue to go into M&A.
Also just take us through the margin levers at play, along with, of course, the cost side of things, because you've ended the year, annual basis, margins are just under the 22% mark. As we roll forward in this year, do you see levers at your disposal where perhaps you can breach the limit of 22% as well, EBITDA margin?
Yeah, so be the nature of the software business is such that with scale, the economics does improve, right? So which we've been saying, but what we also been doing is most of the R&D that we've been doing, we've been expensing out, we don't capitalize it. So the communication we've had with investors for the last 3 years, pretty much, most of my earnings call, I say the same thing. We will try to keep the EBITDA at about 22% levels, between 20 and 22, and we'll pour the excess back into R&D because, the size of opportunity in front of us is so large that we will really not be doing the Aurionpro shareholder justice if we do not keep on upping the R&D spend every year. So we will, up it to almost 100 crores plus this year. Right, so that's sort of the play on R&D. The EBITDA, actually, if you look at it, we also had an ESOP cost for the first time hitting us last year, and that's probably of the order of about 1.2% or 1.3%, right? So if we did not have that, that's not a cash expense, of course, but obviously it hits the P&L. Otherwise, the EBITDA would probably have been 23 plus.
So continued investments in R&D. Therefore, your guidance, you're going to stick to the upper cap of 22% as of now. Okay, got that. Just take us through some of the fundraising plans as well. Rima was earlier telling us that the preference issue plus the QIP, I think the total comes to about 570 odd crores. So what are your plans with the money? Would you be needing to raise any more in this year?
Yeah, so we don't look as a business, we don't really need capital to keep growing organically the way we are going. I think we spin off enough excess capital to invest back into the enterprise. So we were trying to create a global player which can, our stated vision 2030 is to be a top 3 player globally in each of our spaces. That is a very, very large goal to go after, which means we will find gaps in our strategic blueprint, which means we will sometimes, decide to do an M&A to plug that gap instead of building it ourselves, right? So every single opportunity that we build against every single gap, you have always a buy versus build choice. And sometimes we find like-minded management teams. Sometimes we find, the right kind of assets available at the right valuation. And then we do that M&A. So I think we'll continue to do that to continue to grow at our pace. I think we probably added 35-40% staff over the last 12-14 months. Right, so that also needs a lot more, capital going into the fixed assets.
So Ashish, sorry, since you brought up M&A and you're still open to more strategic opportunities, A, is there anything on the table right now? And B, when we just discussed the top line growth trends, the 30-35% growth that you're talking about, that's purely inorganic, right? That's not taking into account any of these strategic options that you're also exploring?
Yeah. So I think the 30-odd% we will continue to grow organically. I think the order book is strong enough and the pipeline is strong enough. The only thing we need to do is continue to scale the delivery capacity to be able to do that, and that needs some investments into the enterprise, right? So we don't need to do M&A to continue to grow at that level, but just to speed the time to market in terms of the products we want out, in terms of what the market needs. For example, the whole AI enterprise AI play that we are building out. We will find opportunity to do some meaningful M&A, and we always have a pipeline of potential targets. But we have zero FOMO when it comes to deal making. It only when it really makes sense for the Aurionpro shareholder, and it really.
So Ashish, if there is no pressing need to do an M&A right now, why is it that you've raised so much money then? Because there is opportunity, right?
Rima, I think the idea is not whether you need the capital to continue to grow organically. I think the idea is how do you capitalize on the really large opportunity in front of you, right? So whether it is in lending, whether it is in transaction banking, we've built out tier 1 assets which can really go and play globally. right? And then, so the idea is not, can you keep on growing at 30%? So the
No,
way to
got
look
that. But
yeah.
so is it possible that you will do an acquisition to capture the large opportunity in front of you in FY25?
Is
that likely?
Certainly possible, both from a product standpoint as well as from a market access standpoint, because we're very serious about being in US and Europe, right? So it's always possible that we find the right opportunity.
Okay, Ashish, thank you very much for that. We had more questions for you, but for now, we're going to take that the company is confident about growing at 30 to 35% over the medium term, not just in FY25. They've been holding on to this growth rate for the last many years, and that's going to continue. And margins too will stick closer to 20 to 22%.
Okay, let's take that quick break. We'll come back on the other side. And a lot of buzzing stocks today, lots of reactions to earnings as well. We'll discuss all of it in just a bit.
Welcome back. Even as the frontline indices continue to trade sideways, lots of individual stocks are on the move. So first up, let's get in our colleagues in and talk about Siemens. They've reported a good set of earnings. Vamakshi joins in with the details. Vamakshi.
Well, absolutely. A beat across the board is what Siemens has reported this time around. Revenue has come in at 5,750 odd crores. This is 4% above our own expectations. And in fact, this growth is largely being led by smart infra, digital industries, mobility, while the energy business also saw an uptick of almost 5%. The margins have also improved significantly for the company. In fact, we were expecting margins somewhere around 12.6%, and the EBITDA margins for the company have actually come in at 15.3%. And in fact, a margin improvement is being witnessed throughout all segments that the company operates in. Net profit has come in at 802 crores as compared to a poll of almost 571 crores. So this is nearly 41% above that what we were expecting. And the profitability improvement, a major chunk of it is being largely driven by volume as well as price effects, as well as the continued productivity measures that have been undertaken by the company. Apart from that, the company also highlighted that the government infra spend appears to be quite robust, and they're beginning to see some green shoots in the private capex side as well. Overall, to capitalize on this opportunity, they've announced total capex of over 1,000 crores in the medium term. Apart from the capex that they announced in November 2023, they've gone ahead and announced an additional capex of 333 crores for smart infra and switchgear expansion in Goa, and 186 crores for setting up train manufacturing facility in Aurangabad. But another kicker has come in from the company. They have decided to go ahead and demerge the energy business into Siemens Energy India, which will be a separately listed entity. And the expected timeline is till calendar year 2025. But what's disappointing this time around in the numbers is the order inflow. New orders have come in at 5,184 crores. This is a downtick of almost 9%. Keeping aside the large locomotive order that the company received in the same quarter previous year, they faced some deferment in some large orders, and they also witnessed some slowdown in ordering of industrial automation products. But let's also look at what a brokerage has to say. Jefferies says that the company in the long term could benefit from sizable power transmission capex. They've gone ahead and given the good set of numbers, they've revised their EPS estimates by almost 2 to 19% for FY25 and 26. They've given a buy rating and raised their target price to 8,000 rupees per share. So overall, a good set of numbers. Jefferies has also given a thumbs up to the company. The stock is in focus, but let's also listen in to what the management had to say.
In terms of ordering, so there are two parts. One is the normal projects and standard business is doing well overall. We are growing overall. Our first half year has been good. If I look at the first half year, we expect to continue to grow healthily for the second half year. The challenge that we have is only the slowdown in one part of our business, which is in the industrial automation part of our business, which is where we expect that there will be a normalization in the demand starting in the October-December quarter. Volumes have gone up, and with the volumes going up, there is definitely an impact, a volume impact appearing in the margins there. In addition to that, there have been cost control measures that the company has gone into, has carried out, as also other productivity measures in our factories and other areas. In addition, we've had some special earnings because of sale of some property and some dividend that we received. So overall, our intent is to continue to grow the margins as we increase our digital component in the business. There will be an increase in margins as we increase the digitalization initiatives that we have launched here in the company.
Okay, market seems happy with everything they've heard from Siemens this quarter. Stock's been holding well, 7% higher. Let's move on to another one where we're getting a positive result reaction, and that's Oberoi Realty, up almost 3-4%. This, of course, on the back of the Q4 print. Let's go across to Sonal and get in the details. Sonal, so is it looking all good?
It's a good set. We did get the operational update earlier, and that looked good on a quarter-on-quarter and on a YOY basis, and that is something that has continued now as well. Let's look at the P&L fast, because they have seen a lot of new project completions that have been accounted for in this quarter. Revenues up 37%, EBITDA up 7%, margins they have declined on a YOY basis, but profits have come higher by 64%. Their total units booked at 227 is an increase on a sequential basis. The booking value at 1764 crore rupees is a big jump on a sequential basis. Even collections are higher at 1077 crore rupees. Additionally, the board members, they have passed an enabling resolution to raise funds via QIP, and fundraise up to 2000 crore rupees is what the board is looking at. So good set coming in from Oberoi.
Okay, thank you very much for that. And finally, Radico Khaitan is also higher post the Q4 numbers. Mangalam joins in with the highlights. Mangalam.
Well, the performance of Radico is quite a descriptor of what's happening in the consumption space, which is the premium products doing extremely well. And that's reflecting in their revenues, EBITDA, as well as the profitability is too. So we have the fourth quarter numbers, a 30% jump in net revenue if you take out the excise expense, and then the EBITDA as a result of which have seen a jump of 55%. That means a margin improvement of nearly 200 basis points as well. The net profit, of course, has increased by about 26.5%. The total volumes of the company have declined by about 1.2%, but that's largely because of the decline that we saw in the popular segments. In fact, the prestige and above segment saw a growth of 14% of the volumes. And that's not all. The revenues for the prestige and above segment increased by 16%. They're at around 503 crores. Not only that, the company is also positive about the outlook of this very segment in the next 1 year as well. They will continue to deliver double-digit volume growth in the premium volume business, in the premium alcohol business in FY25. They're cautiously monitoring the trends in the prices of grain, ENA, alcohol, and glass bottles, where volatility still persists, but they will continue to spend about 6 to 8% of their revenue in ads and sales promotion. So confident sounding management, especially when it comes to the premium luxury products that they are seeding, likes of Rampur as well as Jodhpur, Jaisalmer gin and premium whiskies, all of them doing extremely well for Radico Khaitan.
Thank you very much for that. Get into a break. We'll discuss market technicals with Soni Patnaik on the other side. Stay tuned. Welcome back. The Adani Group stocks continue to see buying for the third day in a row. Adani Enterprises, Adani Ports have both moved up close to about 1.25%. M&M has been the star this entire week. So M&M's moved to the day's high. And this week, it's seen a rally of close to about 5%. So that's holding up the auto pack. But if you remove M&M, a couple of the others are under pressure. So Eicher Motors, Bajaj Auto, both of them are staring at cuts of close to about 1%. And Apollo Tyres too reported their Q4 numbers yesterday post-market hours. Disappointing set of numbers, a miss on the margins. The company's revenues are absolutely flat on year-on-year basis. So it's underperformed, CEAT and MRF. So Apollo Tyres continues to see some amount of, selling pressure today. But let's get to the market technicals then. Soni Patnaik from JM Financial is now with us on the show. Soni, morning, and thank you for joining in. Very directionless, still very much range-bound on the Nifty. In the near term, is there a trade, and are you sensing a breakout on the index? And what have you made of the broader market outperformance and your stock recommendations?
Good morning, Reema. Thank you for having me on the show. I think Nifty is very much in a sideways range between 22,000 as a good support on the downside. On the higher side, we can see there's a lot of call writing happening at 22,300. So that is definitely a good resistance for the day. I think Nifty can see a short covering only if it's able to take out the resistance of 22,300 in cash level. Only above that, you can see a short covering towards 22,600 for the week. I think it'll be very important for today and tomorrow that Nifty trades around the resistance and attempts to break out above the resistance. Then only we can see the short covering coming in. But as of now, it's pretty much a sideways range. Similarly, for Bank Nifty also, if we can see, it's in a very short range of 500 odd points for Bank Nifty between 47,500 to 48,000. It's very tight range. So I think Bank Nifty can see short covering only if it's able to cross above 48,000, 48,100. You can see the short covering towards 48,600, 48,800 for the week. I think it could happen. Today is a weekly expiry for Bank Nifty. It may be the last hour of the volatility that can see Bank Nifty breaking above the short covering range, and just the support that can be needed for Nifty as well. I think it's better to just stick to stock-specific approach. And the first stock pick for today would be Wipro. We've seen good support in Wipro around 445 levels. So keeping a stop loss of 445, Wipro can be bought at current levels for a target of 480, 485. The second stock pick would be in Indigo. We're seeing a good breakout in Indigo above 4,200. It's a good option chain breakout in Indigo as well. So keeping a stop loss of 4160, a target of 4340 can be seen in Indigo.
Okay, all right. Got that. Soni, thank you very much for the trades. Appreciate you joining us today. Well, with that, we do have to slip into another very quick break. We'll come back on the other side and then we'll discuss some of the fundamentals. Devang Mehta of Spark Private Wealth Management will be with us to give us some ideas. Welcome back. You're with us on Trading Hour. Now, AI is the most powerful word in our world today. Its transformative potential is perhaps unparalleled. TCS has conducted a comprehensive global survey on the state of AI adoption and its impact on businesses. The study surveyed nearly 1,300 CEOs from 24 different countries. So it's very, very exhaustive and comprehensive. Rima is here with some of the key findings. Very curious to know what they are, Rima.
Thanks so much for that. So as you pointed out, the survey is extremely comprehensive and exhaustive. They've interviewed 1,300 CEOs across various business categories, right? So the question number one is, what was the impact of the transformative potential of this particular AI technology and how does it compare with the past? Well, 54% of them believe that the impact of AI is greater than or equal than the impact as compared to the internet, while 59% of them believe the impact of this, the potential of AI is greater than what we've seen in the case of smartphone. Now, that's question number one. The second question that the study asked, and just for the sake of brevity, the survey is very comprehensive. They talk about various aspects, but we've just drilled it down to three particular questions. The second question is on the impact of jobs. And here, the opinion is fairly divided. So 49% of them believe that it's not going to have a major impact, while 47% believe that AI is going to result in more jobs being formed, rather than being eliminated. Well, the third question that we asked is the impact on productivity, right? And here, almost 88% of them believe that AI is going to have some impact on productivity. It's just about 12% of them who believe there's not going to be much impact. 40% of them believe that there is going to be an incremental impact on the productivity, but nearly 48%, adding the last two columns, we're going to see a dramatic increase in productivity because of AI, right? Either 2x or going up to even 4x. That's the impact that we are seeing. Now, moving on, right? In this age where we are seeing customer spends, enterprise spends getting compressed, if you want to spend on AI, then you need to make a solid use case for it. But measuring the success of AI is very difficult. 72% of them believe we need better KPIs. If you don't have better KPIs to measure the success of AI, then how do you go ahead and convince your boardroom about it? But that's not the only challenge which is facing enterprises when it comes to AI adoption. The survey also went and asked that what are the three challenges when it comes to you going ahead and adopting AI? The first one is IT infrastructure. The second one is customer expectation. And the third one is IT service providers. That's about AI. If you bring with itself generative AI, then it brings with itself a whole new gamut of challenges. And top of mind is going to be the ethical and responsible use of AI and also on the security and the privacy issue. And of course, the other issues are also talent development and lack of, IT readiness. So there's no taking away that, AI is going to be extremely transformative. And let me end by telling you two more statistics that the survey, threw up. One is that 86% of the people, that's 8 out of 10 people, have already deployed AI to enhance their revenue. And most of them are using AI to look at new revenue streams, enhancing their top line, rather than just focusing on bringing down the cost aspect of it or improving the productivity. So the focus is more on using AI to grow their business, to innovate and add to the top line. Back to you.
All right, Reema, thank you very much. Very, very interesting there. The AI trend, or rather the AI revolution that is perhaps reshaping the world as we know it today. Well, with that, let's get to that promised conversation on market fundamentals as well. We have Devang Mehta joining in from Spark Private Wealth Management. Devang, thanks very much for joining in. Before we talk markets and the rest of the themes, since Reema was just telling us about this very interesting TCS AI survey, your own thoughts. I mean, we've heard from all the top IT companies, even all the, the mid-tier IT companies at the end of the fourth quarter. And most of them, from mid-size to large size, everyone is looking at AI adoption and how they can integrate AI offerings as part of their, service offerings. What's your take on IT as we know it? And, if you were to buy anything right now, what will be the factors that you consider and what sort of companies will you look at?
Thanks, Surabhi, for having me on the show. Pleasure, as always, being on CNBC. I think, yes, what we have seen is across IT, we know that there was a slowdown which was imminent in the last couple of years, that spends were not so high. And that's why I think we all went through that gradual slowdown. And now I think increasingly the commentary is becoming a bit encouraging. But yes, to answer your question on what is the future, where probably this IT services company need to go, some of them have already converted a lot of their revenues to even digital revenues. And now going forward, a lot of robotics, a lot of artificial intelligence, ERD, is the way to go. So I think IT is into a transformative phase. Gone are the times when only your IT services or IT products would probably give you a greater valuation, or this business was non-competitive at that time, or less competitive is the word which I may use. But now if you probably want to either take the leading advantage or the leader's advantage, you need to gradually move yourself into such fields as AI, and most of these companies are doing it. So a lot of mid-cap companies, IT companies, just giving certain examples like Tata LXI, L&T Technology Services, all of these companies, though will be a bit volatile in terms of their numbers, but they're already increasingly getting into ERD, AI, or sort of robotics. And I think these are companies which one should look at if they're talking about new age. This company has earnings, this companies grow at a good speed in terms of even the revenues, and they have good clientele also. And I think they are also innovators in a way.
Okay, all right, got that. So that's a take on IT. Devang, let's talk markets overall now. So caught in a bit of a range as the Q4 season gets into its last leg. What do you make of things right now? I mean, the whole pre-election jitters, the fact that the market's been very range-bound. And I mean, we've stalled. There's no other way of putting it. Now, 5 months into 2024, and the great bull run has entered into a consolidation phase. Your thoughts?
Honestly, Surabhi, it's actually good for the health of the markets if I can dissect, because last 7-8 months, every month we see markets going up generally, and then a correction also starts, and we feel that the market is going through a phase of consolidation or apps or corrections that are due. I think after such a fast and furious rally, there are actually no complaints, because more or less most sectors have come to the fore. The sectors which were not doing well 2, 3, 4 years back, they've just come back with a vengeance. And with earnings, it's not that the sectors are just doing well because it's liquidity in the market, but because earnings have sort of followed the PE expansion. So my sense right now, if I give you on the markets, is that we will probably in the next couple of years, we will have 3 phases in the market. The phase that we are right now is probably we had a good PE expansion for the markets, which was preambled. It sort of pre-rallied in between. Now is a phase where you are seeing earnings growth. I think the last 2-3 years have been good for earnings growth, and I don't see any reason why the next 2-3 years will not be a good years for earnings growth. So now markets probably will grow in line with earnings growth. You have to buy companies which are going to grow at say 15, 20, 25% earnings growth, and I think your stocks can probably also compound. And the third phase will be a bit of consolidation correction that will come imminently in between. So there's 2 or 3 phases. One needs to go through all these 3 phases to sort of create wealth. And that's why I think it's not an easy ride from here. But as I said, if you just be in the markets, I think that the returns to be made.
Devang, morning, and thank you for joining in. Capital goods is, continues to throw up a, fair amount of interest, and even the numbers, the order booking has been strong, but the performance largely has been fairly varied. So ABB has been strong, but L&T has missed on margins. So it's all about picking the right stocks. Which one would you recommend?
I think, yes, Rima, I've been on a lot of shows with you, and I think most of this capex-oriented themes, we have always sort of been very, very bullish over the last couple of years. So not only capex, but a lot of power ancillaries, a lot of such companies which are at the starting point when you do capex, right? So we have been bullish on those. So some names which immediately come to mind, which are a lot of portfolio businesses, not recommending them, but which have given fabulous returns, and we are still bullish from here on. Something like a Hitachi Energy, which demerged from ABB, which was called an ABB Power Product, and Hitachi came and acquired the company, and now it's doing fabulously well across the stream of businesses that it operates in. A wonderful EPS growth over the next 4-5 years is estimated for this company, which is virtually market leader in a lot of segments. So Hitachi Energy being one. The second is ABB, of course, you talked about that. Siemens is another company which is a portfolio stock. And then, of course, if we drill down into engineering companies, there are companies like Pitti Engineering in the small cap space. These are companies which we have been sort of bullish, because once you know that there is brownfield projects, there are greenfield projects, there is manufacturing capex, there are warehouses being set up, there is FDI being coming, there is manufacturing revolution. I think all these are companies you shouldn't ideally miss over the next couple of years.
Okay, all right, interesting. Appreciate that view. Devang, good to have you on the show as always, and we look forward to the next conversation. Well, with that, let's quickly take a break. We'll have a lot more for you lined up on the other side of the market. We'll also put the spotlight on the metal space in particular. Prices have been going higher in the international markets, plus there are lots of developments with respect to tariffs with the announcements coming in from the US last night. Rahul Jain will join in with a perspective.
Welcome back. Let's look at metals now. Metal prices have been trading firm, supported by bullish long-term demand. In fact, copper is at a 2-year high, while many of the other commodities are trading at multi-month highs. Manisha gets us up to speed. Manisha.
Well, metals of all category continue to shine bright. April was a stellar month, and the month of May seems to be building further onto this. There are concerns about supplies going forward. The long-term demand promises on the higher side, and we have seen mine supply concerns. Inventories have continued to deplete, and markets are looking at the older avenues in sense of demand and the newer ones as well. For example, EVs and AI, data center, and even weapons for that matter. The demand from all sectors seems to be increasing on the higher side. So you have the copper prices, which are trading at 2-year highs on LME, but in Shanghai, in US and in India, the copper prices are trading at an all-time highs. We have seen inventories continue to decline. The expectation that you could be looking at a deficit in case of copper supplies going forward in 25 and 26 is what markets are baking in right now in sense of prices. Not just copper, you have lead, which is trading at a 24 weeks high. Zinc is trading at a 13-month highs. Tin prices are trading at a 2-year highs as well. We also have seen a smart up move come in for the iron ore prices. So when you look at the prices in the last 1 month, we have seen the best performance come in from copper, which has gained up by 17%, a 10% jump up in case of iron ore, and a 6 to 9% of gains is what we've seen in the last 1 month for metals like zinc and nickel and lead. The only metal which hasn't performed in the last 1 week or last 1 month has been aluminum. The prices here are down by a quarter of a percent, because you have seen inventories in aluminum continue to gain. The aluminum production in China is at record highs. So barring aluminum, almost everything else seems to be trading at a multi-month and a multi-year highs right now. All right. Thank you very much for that, Manisha. Appreciate that roundup. So metals, commodities and specifically metals definitely having a good year so far. Well, now what to do from a stock perspective? That's the question that we are discussing with independent metal analyst Rahul Jain. Rahul, appreciate you being with us on the show. So, we were just hearing all the fundamentals from the global market side with our colleague Manisha over there. But stocks have also run, right? I mean, it's been a very good rally for most. The metal index this year is up about 17%, one of the better performing indices. So the question is, what is still left on the table? You give us your sense, ferrous, non-ferrous. Where would you still bet for the rest of this year?
So, see, the commodity underlying demand strength is quite good. We've seen a lot of investments, particularly with respect to transition for the carbon emission transition, and then EVs and all those things. So that's been the major overall macro driver. Coming to say India, so thing is that a lot of the stocks were very, very underpriced up till a while back, and there is repricing definitely happening. So if you start with non-ferrous, so Vedanta has been at the forefront in terms of adding capacities. They've been very low cost. Obviously, they've had a lot of balance sheet issues, which gradually can get resolved if these kind of prices sustain for even a 6 months to a 1 year period. We're going to see massive earnings upgrades coming there, especially because if you start, repricing, putting in current commodity prices, plus you added the currency weakness. And also another major thrust that is happening is that there are a lot of raw material integration is increasing. They're adding new bauxite mines, new coal mines. So you can see a significant earnings upgrade coming in here. And similarly, it also holds true partially for Hindalco. In case of Hindalco, they're adding, they're getting their Novelis business listed. Now we're hearing very big valuation numbers of around 18 billion and things like that. So if you just try to do a SOP valuation, you could see 50% kind of upside just based on if the Indian market also starts valuing Novelis with not much of a holdco discount. So there is a lot of earnings upgrade. That's the reason why these stocks are moving higher. And I think there is a lot of more upside coming in from here as well. If you move to the smaller names now, for example, for iron ore, which I think has seen a 10% rally. So Indian Steel is going to add a lot of capacity over the next 2030. We have a target of 300 million tons. And, so we need a lot more iron ore than what we're already doing. The major players in that would be NMDC. There's also Godavari Power, which is adding a lot of capacity. Then there is Lloyd Metals, which is also has very big plans to add iron ore capacity. But thing is that they can easily get constrained. So obviously, market is started giving much better valuation now because the cash flows have been very robust, and Indian iron ore is at a huge discount to the Chinese, iron ore landed prices. They're at about $130 kind of. We are you X mine prices are about 6,000 rupees. So the huge gap which is there, and definitely is kind of so there is a lot of investment going to happen. And see the economic state that India is in when we talk of GDP going up so many trillions and things like that. It's metals which is going to see the maximum demand growth in the initial phases. So long as our per capita does not reach $6,000, the growth in metals will be much higher than the growth for services and things like that. So I think
So Rahul, if you had
to stocks, yeah.
So just if you had to recommend two stocks where the upside is the most, which ones?
So you can see that the mispricing and plus the commodity basket for Vedanta is fabulous. They have a zinc exposure, they have iron ore, they have steel, they have crude oil, they have aluminium, which is actually the largest in the country. So Vedanta, I think, would offer significant. But case of Hindalco, it's more of a repricing for the Novelis asset. Although there was setback when they increased the capex budget for Novelis, but I think that will be taken in a stride because the valuation what they seem to command of their significant. And in case of ferrous, obviously the larger ones are much better. So over here, say JSW has always been slightly expensive. So although they have a very robust pipeline, but I think they're slightly traded at a premium. And in case of Tata Steel, they've had these issues in in Chorus, but that's getting resolved gradually. So that is also a player. But I think in steel, the smaller players are looking far more interested. For example, like a Godavari, which I mentioned earlier, which is not exactly a pure steel play, but it's more of a iron ore plus steel play.
Okay. So you like Vedanta, you like Hindalco, and perhaps Godavari Power and Ispat in the smaller players, right? So quick word on Vedanta. They're raising money. There is a board meet tomorrow scheduled to raise some money via rights, FPO, equity. How much do you think they will raise? What's the market expecting, and what would be the utilization?
So I don't really have a number on that, but see, obviously the key issue is the debt on the Vedanta balance sheet and the parent balance sheet. And the faster they get it lower, say, I think once you drop below a number of, I think currently it's about 6 billion. If they get below 3 or 4 billion, nobody will even talk about it. Then we can see a quantum jump in the repricing of the domestic stock. because that's a big overhang which is there. And once that gets out of the way, we can see the stock trading at fair value, which is significantly higher from here. And also there is a caveat that the current commodity prices hold for some time, which seems to be likely because we've seen the kind of move after some time. So these kind of don't fizzle away so easily. And like I said, also there's a lot of raw material integrations is going on. So that will also lend support to the earning growth that we are expecting.
Okay, all right. Rahul, we'll leave it on that note. Thank you for joining in and giving us your views on a lot of these metal stocks. Well, we do have to take a break on that note, but on the other side, we'll come back with a couple of interesting updates from the market, including, of course, the MSCI revisions. Before we take the break, as India enters the last lap of elections, Network 18 travels to the heartland of the Hindi belt of Uttar Pradesh with a group of business leaders, investors and ambassadors to get a glimpse of democracy in full swing. Among the 14 key constituencies in Uttar Pradesh, which will go to polls next week, on the 20th of May include Lucknow, Amethi, Raebareli, Jhansi, Barabanki, Faizabad. We hit the road to meet leaders like Rajnath Singh, Smriti Irani, Ashok Gehlot and several others. Welcome back. You're with us on Trading Hour. Well, MSCI has announced a list of additions and deletions as part of its May index review. Vivek is here. Some stocks gaining as they gain entry into these indices, and some are on the red side. Vivek, fill us in with the details.
Well, that's right. So early today, or very late last night, if you could call it, MSCI released a list of stocks, that have been added as well as deleted. Now, the index that we are discussing first is the MSCI Global Standard Index. As far as India is concerned, it's named as the MSCI India Index. So now, after this particular review of the MSCI, India's weightage as far as the MSCI Emerging Market Pack now moves up to 18.8%, which is its highest ever. So on May 31st, when these adjustments come into place, India will see inflows of close to $2 billion, a sizable figure by any stretch. Now, talking about which are the stocks that have made the cut this time around, remember, a lot of these stocks, have already been penciled in by quant analysts well in advance. So the street already knew them, and a lot of positioning had already been done in advance for most of these names, especially the stocks that are present as far as the futures and options segment is concerned. A lot of reaction today that you're seeing is also in the cash market, where positioning was relatively lighter. So which are the stocks? 13 additions, 3 deletions from the MSCI India Index. Bosch, Canara Bank, Industar, Jindal Stainless. These are the stocks that have made it. JSW Energy today a large move, cooled off a little bit from the day's high. Mankind Pharma, NHPC, PB Fintech, Phoenix Mills, Solar Industries, Sundaram Finance, Thermax, again a very large mover in today's trade on the back of the inclusion, and Torrent Power. These are the stocks that have made the list this time around, largely along expected lines, something that we had highlighted yesterday as well. On the other hand, which are the stocks that have been deleted from the index on the back of weak price movement in the couple of months preceding to the entry? The ones that have been removed are Berger Paints, Indraprastha Gas, as well as Paytm. So all these 3 stocks will be removed from the index on May 31st. Now, coming to the MSCI Small Cap Index, 28 additions and 14 deletions and what you are seeing. And like we had highlighted, HDFC Bank, MSCI has kept mum on HDFC Bank weightage increase, given the fact that it narrowly missed the weight increase event on the back of having foreign headroom less than 5 basis points. So HDFC Bank continues to remain on shareholders' mind for this particular event.
HDFC Bank continues to sulk, down 1.25%, and Thermax is the big winner with the MSCI weight increase up 9%. But getting on to the primary market action, the 2,615 crore initial public offering of Go Digit has opened for subscription today. Yash joins in with the details on this new debutant. Yash.
Well, Rima, after New India Assurance and ICICI Lombard, Go Digit General Insurance is all set to become the 3rd company to get listed on the exchanges. The issue opens today, closes on May 18. The price band is between 258 to 272 rupees per share. As far as the fresh issue is concerned, the size of that is about 1,100 1125 crore rupees. As far as the offer for sale part is concerned, the size of that is about 1490 crore rupees. The total issue size coming to about 2615 crore rupees. As far as the selling shareholders concerned, about 99.98% is being sold by the promoter entity itself, that is Go Digit Infoworks. As far as the object is concerned, the entire amount raised through fresh issue, that is 1125 crore rupees, going towards enhancing the solvency margin for Go Digit General Insurance. So a quick look at the financials. These are as of 9 months FY24, gross written premium up 26%, net earned premium up 36%, operating loss was down 82% at 10 crore rupees, net profit of 129 crore rupees, combined ratio is at 108.7, number of customers added were up 22% and policy issued were up 10%. When one compares Go Digit General Insurance to ICICI Lombard and New India Assurance, it's a much smaller company. Total income of ICICI Lombard is 2.5 times and New India is 5 times bigger than Go Digit. ICICI Lombard issued 3 times and New India Assurance issued 3.5 times more policies than Go Digit. ICICI Lombard's gross weighted premium is up 3 times. New India is up 5 times as compared to Go Digit. As far as two important parameters are concerned, operating profit and combined ratio, Go Digit is standing with an operating loss of 10 crore rupees. ICICI Lombard has an operating profit of 1344 crore rupees. Combined ratio itself, Go Digit has 108.7. ICICI Lombard is much better at 103.7. But the valuations, Go Digit seems to be coming at a higher valuation to the market. The valuation which Go Digit is seeking at the upper end of the price band is 9.7 times price to book value. ICICI Lombard is about 7.95 times price to book value. New India Assurance much lower at about 1.4 times price to book value. Key 5 risks, if I have to point out, one is operating underwriting loss for the company may continue because investments could remain elevated. The second one, the expenses of management guidelines from IRDAI could put some constraints on spending from Go Digit. Third one, dependence on brokers for distribution of insurance policies. Fourth one, the geographical concentration. About 55% of the revenue comes from Maharashtra, Karnataka and Delhi. Any catastrophe incident in these states could pose a problem for the company. And the fifth one, dependence on motor portfolio. About 60% of the revenue comes from motor. Any problems in that particular portfolio, either from the pricing point of view or the regulatory point of view, could create problems for the company going forward.
Got that. Yes, this is really interesting. There also, I guess health is also a reasonably big segment for Go Digit, right?
So health, if I have to say, it's a much smaller segment, just about 14%. If you look at the entire general insurance industry, the split between motor and health is 40-30. For Go Digit, it's much lower at just about 13-14%.
Got that. Very important and very interesting details you've put up over there. That combined ratio, that's kind of a, maybe a red flag for some, and that operating loss. But, well, it's got star power, and we know whom we're referring to over here, right? With Virat Kohli having a personal interest in the company as well. Let's see how the market reacts to this one. Very interesting analysis. Thank you very much for it. With that, it's a wrap on this edition of Trading Hour. So, Rima, I and the entire team, we take your leave, but don't go anywhere. Stay tuned. Halftime report will take the action forward.